What is up, everybody? Welcome back to another episode of FedWatch. This is actually going to be a supplement to yesterday's live stream. So yesterday's live stream took place 4/26/2022, and we talked about this IMF debate that happened on the 21st, and we couldn't get the clips together in time. So I wanted to just provide this little supplementary video slash audio for you guys so you can hear what we heard. And yeah, that's what we're talking about. So let's jump right into it. I think I got my levels correct. Let's go.
Risk, but I do want to hear the individual outlooks, especially from Europe, President Lagarde, because of its proximity to Russia and Ukraine, the spillover effects that you're seeing, and now there are concerns about stagflation there and the effects where it depresses economic growth and drives up prices. So how much has the outlook for Europe changed?
It has changed exactly in the same direction as indicated by Kristalina. So it's been a haircut to growth projections, and it's been a rise in the inflation numbers. And certainly when we look at the risks, they're skewed to the downside for growth. So there might be more cuts to come, and to the upside for inflation. That's where we are. And it's particularly saddening, not only because of the death, not because of the destruction, not because of the devastation, which in and of itself is a cause for huge concern and sympathy and support for the people of Ukraine, and blame for those who took the initiative of that unjustifiable invasion, Russia. But it's also causing harm throughout the world, predominantly in Europe for the moment, but it will, there will be ripple effects going way beyond Europe. For the moment, as you said, geography plays a role, and Europe is literally next door. Ukraine is one of us, and taking this horrible hit. We are seeing refugees out of Ukraine into many of our European shores and countries, and we have to, by solidarity, do everything we can to support them.
All right, so that was just the first answer clip here from Christine Lagarde. And yeah, she talks about Ukraine. We go over that on the live stream, but just to sum it up, they don't even talk about the sanctions at all, right? Like the economic fallout is not, well, it's a little bit on the food side maybe from the actual invasion, because the half of the fields were not planted in Ukraine. That's what I've seen. But the other economic fallout of this is from the sanctions, not from the actual invasion. But of course, they can do whatever they want, and we cannot judge the response. They are saying the initial invasion was so evil, and it is, but so are the sanctions. The sanctions are equally as evil, actually. Like, look at all of it's spreading this localized, like the localized economic fallout. It's spreading it worldwide. These sanctions are. So they are actually affecting the global economy much more than the initial invasion was. Anyway, so let's go on to the next clip.
As you know, to address inflation, and there are concerns globally about the tightening of monetary policy. What's the U.S. outlook, and how are you feeling right now about your claim that we're not heading toward recession?
I guess I'd start by saying that we are unified with our allies around the world in opposition to the invasion of Ukraine for no reason, and the human suffering that's going on there. And while these economic matters are important, there are very fundamental things at stake there that we want to keep in mind. So in terms of the U.S. economy, we are a bit more remote from the immediate effects of the war compared to Europe, for example. But we will be feeling them over time, and they will come in the form of upward pressure on inflation, further upward pressure, and a bit of downward pressure on output. But the U.S. economy is very strong, performing very well. By most forecasts, we'll have another strong growth year this year. The labor market is extraordinarily tight, extremely tight, historically so, and to the point where really there's an imbalance between supply and demand for workers. And of course, the big issue that we're very focused on is inflation, and getting inflation back down to our 2% goal.
But if we start to slow materially in our economy, will you stop tightening even if inflation is still above your target?
This is an important question, right? She's asking, he gave the party line, and now she is very politely pushing back and saying, look, are you actually going to take us over the cliff in the economy?
Target?
Well, so first of all, you asked about a soft landing. Basically, that's our goal. Our goal is to get demand, use our tools to get demand and supply back in sync, so that inflation moves down, and do so without a slowdown that amounts to a recession.
Okay, that's an important part that we touch multiple times on the live stream. Is that yes, he's trying to get supply and demand back in sync, but he can't affect supply, and he says this later. So what does that mean? Well, in a supply shock, that means you have to pull down demand.
That's our goal. And I don't think you'll hear anyone at the Fed say that that's going to be straightforward or easy. It's going to be very challenging. We're going to do our very best to accomplish that. And it's absolutely essential to restore price stability. Without price stability, really, the economies don't work without price stability. We need that to have a strong labor market for an extended period of time. We need it for financial stability, so we must do that.
The market has 3 50 basis point hikes coming at the next 3 meetings as of this morning. Is that reasonable?
So I try not to comment on specific market pricing for things, but I will just say this. At our last meeting, and this was in the minutes from the meeting, many on the committee thought it would be appropriate for there to be one or more 50 basis point hikes.
Are you one of those people?
I don't disclose my own path. I try to lead the committee, but so I think markets are processing what we're saying. They're reacting appropriately generally, but I wouldn't want to bless any particular market pricing. The thing I want to
I'll add here to that. He's saying that the market is processing what we're saying. So that's what's important.
Say, though, is we really are committed to using our tools to get 2% inflation back. And I think if you look at, for example, the last tightening cycle, which was a 2-year string of 25 basis point hikes from 2004 to 2006, inflation was a little over 3%. So inflation is much higher now, and our policy rate is still more accommodative than it was then. So it is appropriate, in my view, to be moving a little more quickly. And I also think there's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So that does point, that points in the direction of 50 basis points being on the table. Certainly, we make these decisions at the meeting, and we'll make them meeting by meeting, but I would say that 50 basis points will be on the table for the May meeting.
All right. So not much to add to that. We talk in depth on the live stream, so you guys can go check that out. Let's move on to the next clip.
Lagarde, so clear, Europe is dealing with sky-high inflation rates as well, highest we've seen in the Eurozone. Why are you not sounding as hawkish as Chair Powell when it comes to raising interest rates and tackling inflation?
Well, first of all, I'm not a hawk. I'm not a dove, and I'm carrying this little owl with me all the time to remind myself that everything that we eventually decide has to be a concerted, coordinated, collective decision. But I think you ask a really important question, and I thank you for that, because it's often the case that commentators, analysts will just put the two of us in the same bag, and I'm very proud to be associated with Jay Powell because I respect him greatly. But our economies are moving at a different pace. Our inflation are fed by different components, and as a result of that, our analysis of the roots and the consequences of inflation have to be different. Let me just give you an example, and I'll just speak for Europe, and then I'll let my colleague, Mr. Powell, speak for his economy. Given that we have both the objective of price stability, which is the driving compass for us, our inflation numbers are very high. You're right. 7.4% in March, and we will be, more than double above the target at the end of the year. But when you try to understand what comprises that,
get to the point,
that very high number, you see that almost 50% of it is energy prices. So that's a supply shock that we are taking. If I look at my core inflation, so if you take out food, you take out energy, I'm down to 3%. It is north of my target, which is 2%, but it is more manageable, if I may. It's actually 2.9% because it's just been revised this morning. So our inflation is fueled by a supply shock, which calls for a particular type of response, which brings together fiscal policies and monetary policy. And obviously, we cannot operate at the same pace, with the same sequence, using the same instrument necessarily when it's that kind of inflation that we are dealing with. So it is much broader based than it was. It is much higher than our target, but it is supply driven, number one, and it needs to be addressed in a sequential, flexible, gradual way.
All right, so I think the important takeaway there, for me at least, is that I think she did a good job diagnosing that oil and food, or energy and food, are highly volatile. And they don't necessarily mean the same thing as other prices, right? So if, yes, you have a war or you have a drought, the prices of food are going to go up and down. And that doesn't mean it's inflation, right? That doesn't mean that there's actually money printing going on, that they can change. So in this very specific and narrow case, I guess, that it is important to know why you were counting what towards inflation. And that's what she's trying to detail out. Okay, let's go on to the next clip.
What about inflation in the U.S.? Some are wondering if it's peaked. Do you think so?
So let me say one of the great benefits of the IMF meetings is the chance to talk and collaborate, Christine and me and all of our colleagues talk about these things. And we find a couple of things. First is that inflation is really a global problem. It's quite everywhere, and it's high in most places. But there are differences. There are certainly differences. So in the United States, we have very strong growth, and we have higher inflation, we have higher core inflation than Europe does, for example. We also came into this. Europe has struggled more than we have with low inflation, well below target, had a much lower policy rate. So we have a different level of underlying inflation. So they're just differences. And of course, we all serve domestic mandates. So in the case of the United States, we have had an expectation that inflation would peak around this time and would come down over the course of the rest of the year to an extent, and then come down further in 2023. These expectations have been disappointed in the past, and so now we're really in wanting to see actual progress. It may be that the actual peak was in March, but we don't know that, and so we're not going to count on it. And we're also no longer going to count on help from supply side healing. We're gonna if we get that, that'll be great, and I think that would be enormously helpful in having a soft landing. But we're really going to be raising rates and getting expeditiously to levels that are more neutral, and then that are actually tightening policy, if that turns out to be appropriate once we get there.
But isn't it going to be hard to control inflation through tightening when a lot of it is coming from the fact that Russia and Ukraine are major exporters of so many commodities that we need? We don't know how long this war is going to go on. We don't know how long China is going to be seeing these rolling shutdowns and therefore more supply crunch. Isn't it going to be harder than normal to get a handle on inflation through your policies?
Yeah, we of course can't affect supply side issues. We really can't affect much food and energy prices either in the near term. So it comes down to what we can do is our tools work on demand.
That is a very important point, guys. He can't affect supply. He can only affect demand. So if there's supply shock and there's lower supply, higher cost, that means they count that as high inflation. How do they get that back in sync? They have to pull back on demand. And that is scary, right? Like having these powerful people tell you that they are going to pull back on your demand. They're going to make sure that you can't buy as many things, or maybe you don't want to buy as many things, right? They're scaring the market. And I mean, to me, that's it couldn't be more clear than how he's putting it right now. Unless he came out and said, we're going to screw the economy over. That's a little bit different. Okay, let's keep going.
But we have a job to do on demand, and I'll go point to the labor market. There are substantially more job openings than there are people who are unemployed. And if you take total employed people plus job openings, that's demand for labor. If you look at the size of the labor force, there are more than 5 million more demand than there is supply. So we've got a demand-supply imbalance in the labor market and elsewhere in the economy. It's clear, and that comes from a number of things, including fiscal policy, including what we did at the height of the crisis. So there is a demand job to do, but you're right. We can't fix supply-side problems.
All right, and the last clip I have for you guys today in this supplementary episode for FedWatch is this one right here.
The role of the IMF, there is this bigger question right now about the role of globalization in general and the onshoring of manufacturing and supply chain. And it started with COVID or maybe even before that and really got exacerbated by this war in Ukraine. And obviously, Chair Powell, there are...
Before she finishes this question, I just want to tell you guys that, this is one of the things I've been beating the drum on is deglobalization. And now they're asking these heads of these central banks and heads of the IMF. It's a very important question, right? It's a very, very important question. What does a deglobalized world look like? So I want to let this play here for a little while, and we're going to hear Powell's opinion, and then we're going to hear Lagarde's opinion. And I want you guys to kind of listen for the differences between these two things. Okay.
Are going to be ramifications of this for growth and for inflation if we are, in fact, in a world where globalization is going in reverse or even dying. What do you think?
Well, that is certainly a possible outcome here. I think you've seen questions about globalization, and this series of events around Ukraine certainly has the possibility of leading to a more fragmented political situation and economic situation. You saw Secretary Yellen's speech this week about looking to, I think she called it friendshoring. So I think there's a lot of thinking going on like that. The globalization that we had benefits to it, and it had cost involved in it. And these are really questions more for elected governments, I would say, than they are for a central bank. But there would certainly be a different world. It might be a world of perhaps higher inflation, perhaps lower productivity, but more resilient, more robust supply chains. If we were to have, the supply chains that we had were very efficient, but quite fragile, it turned out. So, and I think it's not clear that we're seeing a reversal of globalization. It is clear, I think, that it's certainly slowed down, and it may go into reverse. I don't know.
Is that? Clearly Europe's thinking about it in terms of security and things like energy and dependence on that sort of thing. Do you think we're going in reverse?
No, I think we're going to revisit the terms of trade and who we are trading with and on what principles we are determined to continue trading and reorganizing supply chains. And, for once, I'm quite happy to actually plead for the case of Europe, because there's always Europe bashing now and again. And I think that the work that we had to do over the last
Please, please, please don't deglobalize. I'm pleading for Europe. I'm making Europe's case here. Please don't deglobalize.
70 years. And the adjustment that we had to make, moving from a small group of 6 to now 27 countries, which are all members of this, single market where goods, capital, and people move freely, has been a laboratory of a different kind of trade. And it is not easy, let's face it. There are countries sometimes that are drifting, that would like to operate slightly differently, but where the governance, the rule of law, the principles by which we abide when we join the club keep us together and keep up on track with those key principles that we respect. So it is a bit of a laboratory, and I would hope that as we re-examine and
so those rules and stuff, I mentioned this on the live stream, that is the rules-based international order that is coming to an end. So yeah, that's what globalization is built off of. And everybody is welcome in the club except for people that we don't like Viktor Orban over there in Hungary, or Putin, or anybody who we don't like is not involved in our club. And I mean, it's so hypocritical that it obviously has the seeds of not working out. Like, we can already see the future. It's such a hypocritical thing. No one's going to go for it.
Revisit globalization, which has provided a lot of good in and of itself. We can use that experience to see how we can enforce, how we can govern, how we can make sure that everybody is included, that we don't leave some by the side of the road, but we try to be together and make sure that it is inclusive.
Let's not leave anybody out except for people we don't agree with. Anyway, that's it, guys. Hope this was valuable and useful. I'm going to get this over to the editors so they can release it. Once again, my name is Ansel Lindner. If you want to follow other content that I make out there, go to bitcoinandmarkets.com. I have a free weekly newsletter that comes out every Friday. You just sign up for the free account there, and it'll come right to your inbox. It covers all of the big stuff in Bitcoin that happens every week. Most of the sectors in like the Bitcoin industry are covered in that newsletter. So thanks, guys. We'll see you next time.